guys, welcome to week 3 of the extended analysis of this week's economic data and equities. Week 3, we're basically YouTube naturals at this point. What we have learned so far is people really don't care too much about my economic data analysis. They just want to get over to Andrea, who's here again this week, and onto the part that really makes some money. Yeah, so we're going to cover the economic data. At the end of the day, it does really underpin everything that happens within the equity markets. It was an early start to the week, like we said from last week. Data out of China at 3 o'clock in the morning on Monday UK time. GDP numbers were kind of slightly ahead of estimates. However, they were slightly disappointing on the previous quarter. The real shock came in retail spending for December at only 1.7% against an estimate of 3.7%. The implications of that are basically if China's not spending, the global economy is suffering. Although that does filter in at a time lag, so we could see further pain ahead. Looking at the UK, unemployment falling in the UK, but that was against a backdrop of weekly earnings being down. Maybe that's just reflective of the holiday season numbers. That to read anything into that data is really going to take another few weeks. The big data from the UK this week was essentially RPI numbers, which came in at 7.5%. That really is a little bit concerning, and you can really start reading into that in March we can expect a second rate hike from the Bank of England. That just leaves the US to cover on an economic front. It was actually quite a week than normal in the US. Initial job claims were way above estimates, but again, that's not something you can read a lot into. It does probably just start incorporating the changing count mechanisms about holiday staff and the seasonal staff. Unemployment rate is probably flat at 3.9% at the moment, and you can see that probably stabilising up around the 4.1%, which is just going to be somewhere around, well, still below a global average or historical average. Elsewhere, we've seen the continuing trend of rising treasury yields. They did creep above 1.85% this week. They have come down through Friday trading to slightly below 1.8%. Looking ahead, we can see the pressure on the equities market being maintained. You've got to really expect, and in the not too distant future, sometime quite soon, 10-year treasury yields really pushing above the 1.9–1.95% mark. Economic data in the week ahead, we've got housing data coming up. Again, we focused last week on how important that is right now, and again we've got another round of inflation data. It's just everything is kind of building, and the key data this week will again be expected to add downward pressure to your equity markets.
Yeah, that's enough economics for now. You've said you'll touch on market bubbles. So actually, what is a market bubble?
We mentioned we will come back to market bubbles. Market bubbles have been kind of questioned for probably a good few quarters now. So all I'm going to do is, and I think it's going to be of real interest to some people, is cover the stages of market bubbles. So a market bubble in itself is simply asset classes exceeding fundamental values and pretty much exceeding them by a long way. There's 5 stages to a market bubble. First is cause. A cause of a market bubble begins with basically new technologies or quite often low rates, and obviously right now we have both of that. When I say both, obviously rates, everybody knows historical lows, but the new tech has really come in the form of green innovation and especially electric vehicle adoption. Stage 2 is your boom. During this stage you get adoption of the new tech and more participants entering the market. That's been on the back of the COVID implications, and also basically your retail apps and how easy it is to drag in new investors these days. During that second stage you also have a lot of fear of missing out, or FOMO as the kids like to say, and that just adds to your speculative investments. The middle stage is in the form of euphoria. This is where just everyone says to hell with it, caution is thrown into the wind, and obviously on the back of that asset prices rocket. Your fourth stage is the profit taking stage. This is the bit where your smart money gets out. We've seen that not just in recent weeks with institutions pulling a lot of cash, but I think the overall trend of probably certainly the last 6 months is a trend of CEOs getting out. Special shout out to, and it's dubious whether you can call this smart money getting out, but special shout out to the CEO of Peloton, who he got out at prices 80% above where they are now. I can also maybe touch upon another CEO who's certainly smart, and at this moment in time has got out at highs. I think in a year's time there's every chance you could see him getting out at highs with similar pullbacks. I'm sure everybody knows who we're talking about. Let's just say he runs the world's biggest car company. The fifth stage and the final stage of your market bubble is your panic. Now all it takes to trigger the fifth stage is quite often a very minor event. Relating that to now, whether that is your rate increases, whether it's debt crisis on the horizon, whatever that may be. But the trouble is, once a market bubble bursts, that market bubble can't recover, or certainly not in your shorter time horizons. Rapid price movement, your speculative assets start getting margin calls, your supply of stock far outweighs any demand on the stock, and basically you get into a spiral of just liquidation at any price.
Okay, and does that any of this impact investors' psychology?
Well, this one falls a little bit into your economic behaviour, investor behaviour, investor psychology. There's been a real trend of buy the dip. That's been evident for kind of 12 months now. Certainly won't recommend it. Buy the dip will only ever lead to problems in the long run. You've had the buy the dip investors have got away with it for a long time, but they've had huge monetary support from policy. Obviously, policy is tightening. That's not going to be so easy. A lot of investors go blindly into buy the dip. Any pullback has seen buying. Them investors are now being really shaken off over the last few weeks, especially through your tech stocks. Thursday was a really great example, and it was markets pulled back through early session trading, and then you got a bit of a rally. And this is where it's dangerous. This is buy the dip investors thinking they can kind of steam in and everything's going to be fine. but Thursday's rally came on the back of very low volumes. And all it was markets up and down, the panic is still there, people want to get out of positions they're holding. The rise in markets on the back of low volumes basically it was never going to be sustained. It was just an opportunity for them investors that missed out in early session trading to get out at a slightly higher price, and they took their opportunity. So that's where you've got the danger. Yeah, buying the dip on huge volumes, perhaps. Buying the dip on low volumes, you just can't go there. It's financial suicide.
Right, I think we've covered a lot on where not to put your money. What about sharing where to actually put our money?
Yeah, I mean, it's tougher than normal to. Normally you're planning these moves months ahead, quarters ahead, potentially years ahead. That was kind of our case with our positions through EV. You know, that was planned 2 years ago, and we've been at the point of getting out over the last few months type of thing, or last 12 months in some cases. Where to put the money right now, or where to put your capital, isn't as clear as it always is. I mean, if we start by just ruling out where we're not going, is you've got tech is out, real estate is out, construction is out on the back of rising commodity prices. Healthcare has had its day. We're now underweight on energy. It's not that we've run away from energy, but we are underweight on energy. That has been replaced by going slightly overweight through utilities. Personally, right now, it's not, I know this week's might seem a lot of doom and gloom, but there is places where investors can go to right now. Shipping, really like shipping. I think we should touch on that a lot more in maybe a future episode. And I'm also quite big on e-commerce. Etsy, which we've just flipped, and you'll see the details of that on the Instagram. We flipped that in the last week. That will now become a portfolio hold. Alibaba still has huge upsides. And then we'll continue to hold our Pinduoduo options, which again we touched on in week 1 of the YouTube analysis. We'll stay overweight in financials. We've been strong financials for quite a while now. You've got to be really careful here not to confuse open financial exposure to your big investment banks. Again, if you've watched the last couple of weeks, you know, we were very much against JPM, your Sachs. They've had the day, they've rode their way through probably the most perfect market conditions you'll ever see. So it's not your investment banks that we're particularly interested in within financials. It's your commercial and lending banks. We've recently picked up New York Bancorp, and that's the type of financial that people should be looking at right now. Alright, so let's move on with this week's equities review, where we'll look at not just what's happened this week and the big talking points, but also kind of what we see going ahead for next week. I guess a great place to start again is the Nasdaq, which is really suffering. Are we finished with the Nasdaq declines now?
Right, so in a word, no. Inflation, rising yields, rising input prices, they will all continue to squeeze multiples, and that's even before considering the index that just includes a lot of junk stock. down 7.6% on the week and 12% year to date. It puts it in a correction territory. With the index, you've got now software down 30% from highs. They will certainly continue to come back more, and towards the end of the quarter, some of these companies will start looking very attractive buys, and we will certainly update you guys on what and when. Elsewhere, you can just expect the losses to continue further and to compound and at relative speed. When we're finished, which is obviously difficult to pinpoint, we could see the index roughly around 30 to 40% lower than what it is now.
So that covers the Nasdaq in quite a lot of detail. Where do we see other indexes, not just in the US, but globally, UK, Asia, and even beyond that?
A rate increase will see a lot of S&P casualties, cash-rich companies you can hold rather than sell. The Dow now is down 6% year to date, but breaking the 30,000 level is quite likely. Asia has more downside priced in, but is still quite exposed to the Evergrande crisis. Over the next 2 weeks, it's very likely that the FTSE will lose all its gains. I mean, not all its gains, its gains of recent weeks. It's really only emerging markets, you can say, has all upcoming headwinds priced in.
So we've covered, that takes a look at basically world indices. What about individual equities? What's been the real big news of this week?
Microsoft acquisition of Activision is the first real big play of the metaverse. We still don't know what is the metaverse or what it will look like, but gaming will certainly play a large part of it. The acquisition at $95 cash leaves $14 a share on the table. That's huge. It's pushing 20% over 12 months. The discount comes at as it's a 12-month completion deal with a couple of regulatory hurdles down the way. Microsoft has the cash and it will clear antitrust and anti-competition. The deal will complete, making Activision a considerable upside buy. Traders ran for EA, that's understandable, and both of them and Sony look actually really good in the space going ahead with CD Projekt, the continuing speculative play. Now, about Netflix picked up a lot of headlines, falling 25% on an earnings release. A lot of numbers stacked up well, but subscription numbers hurt a lot. You've touched on household incomes tightening, and subscription business models will suffer, definitely suffer. Netflix are potentially saturated in what they do, and price increases will add further downside to the stock. It's a great company, don't get me wrong, but they will have to buy their way, moving to the next level. What will make sense will be to move into gaming. It's kind of a logical step for them, but there will be some interim downside. In the end, we can still see Netflix at $700 a share in 3 years' time. Finally, if you talk about semiconductor stocks, had an awful week. We sold out of Nvidia weeks ago, and there's no temptation to go back for now. Supply, they can't fulfill demand, and that's a huge negative. We'll cover another time how you've potentially got an oil-like cartel forming.
Right, so I'm glad we've touched on corporate earnings. you know my thoughts on corporate earnings, especially over the last kind of 2 quarters. You've now had JPM that's really struggled on, and this is kind of your blue chips. JPM have really struggled on a quarterly release. Obviously, you've just mentioned Netflix from this week. Basically, how's my temper going to be over the next 4 weeks while earnings season lasts? Is it going to be any better?
Yeah, but better than last season, you're right. Well, 3 months late, but it's reckoning season for many companies, 30, 40, 50% asset price growth against metrics below 3 years ago. Well, it won't hold longer, won't be accepted anymore. Procter & Gamble were last week a positive surprise. It's a genuine expectation beat, 6% sales increase, but half of that on rising prices. That puts price elasticity 30% below what we thought, and that makes it a buy. There's some huge earnings this week, right? You've got Tesla, cost of revenue is key. Musk attends this quarter and expect a retail buying frenzy on the back of mythical Cybertruck stories, but an institutional Tesla tantrum is expected to follow when numbers are crunched. Elsewhere, we are expecting asset price falling on the back of earnings for American Express, Raytheon, Johnson & Johnson, all on Tuesday. You've got Boeing on Wednesday, that could suffer. You've got Comcast Thursday, that will almost certainly pull back. Caterpillar on Friday, that will definitely struggle to justify any of the last 18 months gains. You've got then Dow Inc, Chevron and Verizon that should all hold up okay, and if we're going for an upside surprise, it will definitely be for General Electric.
Well, that wraps up another week. Thanks again for watching. We have noticed, viewing numbers aren't huge, and that's a real surprise with some of the information and some of that information that can be related to profit over the last couple of weeks. Basically, if you guys aren't going to watch, Andrea, are we going to keep doing this?
Don't know. It's a lot of work.
Yeah, it's a lot of my time on a weekend. So yeah, all we can suggest is you guys watch, take from what you can, let us know if it's been useful for you, and of course, like we say, please add comments, get in touch with us if you want us to cover anything in the future. For now, thank you very much, and we'll see you again next week.